Hello and welcome back to Hurdle Rate. Today we are going to build the WACC and the cost of equity for Meta, formerly known as Facebook. So yeah, let's get straight into it. We open a blank spreadsheet. As always, we take off the grid lines, view. We don't need to do anything on this page because it's for the WACC. I'm going to zoom in a bit. And in A1, let's put Meta. Then go to data and we go stocks. Let Excel find it for us. Okay, and there we have it. And let's remind ourselves what the WACC is. The WACC equals the percentage of equity multiplied by the cost of equity plus the percentage of debt multiplied by the cost of debt multiplied by 1 minus the tax rate. So we just have to work out all of these components. Some of them are easy to find, say such as the tax rate, the cost of debt. We can find that in the financial statements. But the cost of equity will take us, it's a bit more of a convoluted journey to get there. So let's start. So the first thing we need is the market cap. And that is A1, open the parentheses, type market cap, and remember to divide it by 1 million. And we do that because Facebook is a $1.8 trillion company, but we want it to be displayed in our units are in millions, basically, which is why we don't have the remaining 6 zeros that are needed. It just makes for it to be neater. The next thing we need is the percentage of equity. Percentage of equity, the cost of equity, and let's make B a bit low. No, not that big. It's a bit bigger. And A can go a bit smaller. I can zoom in as well because we don't need that many lines. Hopefully this is visible on whatever device you're using to watch this. Cost of equity, and the components within the cost of equity are the risk-free rate, the beta, and the equity risk premium. And this is quite a this can be quite difficult to, well, not the risk-free rate, but certainly these two can be a bit lengthy to calculate. Once you understand the method, it's fairly straightforward, but otherwise it can be a bit long. Then the next, we want the debt, the percentage of debt, the cost of debt, the tax rate. Then what's the last thing that we need? We need a total, and then we can get our WACC. So what can we do already? I mean, we can find out what the debt is. We go to the balance sheet. So right now I'm on revenue. Remember this number, this page number 13, because we're going to go back to it. But let's just look at the balance sheet. So this is the income statement. Here it is. Accounts payable, operating lease, accrued expense, and other liability. So, okay, so it looks like Meta has about 28.8 billion in debt. 28,832. So that means we can find a total. When we add the market cap and the debt, that gives us our total, meaning we can then find the percentage of equity now. And it's going to be about, what is it, 95%? Yeah, 98%. There we go. And then we do the same for the debt divided by the total. Very good. And the cost of debt, let's see if they have that. The one way that we can work it out is we do the interest payment work, what this would be for the full year, and divide it by the total debt. So if they're paying 900 million in the first 6 months, let's say it's 1.8 million, 1.8 million divided by 28, and that's one way to do it. But let's see if they've actually written it down. Because if they have, we can use that. But again, I mean, Facebook is predominantly equity. It's got very little debt on it, so we don't have to be. Okay, well, it's not saying, so let's just, yeah, we'll do that. 919 multiplied by 2 multiplied by 2 divided by the total debt. So yeah, so let's see it is about 6%, and they should have the tax rate on here somewhere as well, the effective tax rate. And once we have that, we're good to start on the cost of equity. Where are you? Income taxes. Okay, effective tax rate was 11% for the 3 months ending in June. That's very low. Okay, we'll go with that. Okay, now let's start building the cost of equity. This is what we want to build out using these 3 components. So go onto a new sheet, remove your grid lines, make it a bit smaller here, just pull this. Do we need, no, we don't really need that to be, but we want, just put an X here to indicate it's going to be a section beginning. Now I can zoom in actually, I don't need this much space. Just give this a bit of formatting, fill. What are we calling this? Cost of equity. Risk-free rate beta. What's the first one? Risk-free rate. That is US 10-year. We know what the US 10-year right now is. 4.174%. 4.174%. So equals up here. Let's just make this a bit more. Fill. Order. Copy. There we go. We can even have this. That's the first part. The first. What's the next one? The beta. Now, what we're going to do is, yeah, so we need to fill this out. We need to decide what we think where the category that Meta generates its revenues from. And to be honest, I think most of it is going to be advertising. But let's just have a quick look. So, no, that's the wrong one. Page, family of apps, revenue. Yeah, so the family of apps, the revenue really comes from advertising. Rather than, yeah, here we go. Yeah. So for the 6 months ended, 89 billion came from the app, so WhatsApp, Instagram, Facebook, and then Reality Labs was 782 million. So it's a drop in the ocean. So really, we're going to put Facebook as a what do you call it? As an advertising company. Let's do that. So we just need to put some headings. Industry. The sample size. We don't really need the sample size. It's more just for it's just maybe, I don't know. I've got no good reason. Value, proportion, the weighted beta, and that's all we need. And we're going to say advertising, and let's go software, internet. Let's start populating. So it's 54. Okay, well, let's have a look. So advertising, definitely. Computer services. Then, yeah, software, software, internet, or system and application. I think let's leave it at internet. It's, again, that part is so small. It's such a small part of Facebook that it's not going to have an impact on the beta. So the unlevered beta 1.12. And the revenues for this, we saw it as, wrong page, 8904. Okay, 870. What would we say that is? So 87955 is 1 second. Yeah, so 87955 is for advertising. Other revenue, I wonder what that is. It doesn't. Let's have a quick look to see if they say. Because then we can categorize it further. Okay, segment information. Okay, well, let's put it as, and it says that the Reality Labs is hardware. So let's call it instead. Let's call it so let's not call it software internet. Let's call it software system and no, let's do that one, software internet, and the Reality Labs to be system and application. And that is 333. So for these two, the unlevered betas are 1.56 and 1.2. And the revenues, page 13. Here we are. 1093 782. We do need to total these up. So, okay. EV to sales. We need our price to sales spreadsheet, and we can, we'll just filter out what we need, and then I'll zoom in. Select all, we want advertising, we want the two software as well. There we go. This is what we want. So 2.75, 7.59, and 11.54. 2.75, okay, I can see it a bit here, that's fine. 2.75, 7.59, 11.54, which means the value of each of these segments is, you do the revenues multiplied by the EV to sales ratio. Just pull it down, then sum. So So based on its revenues, this is what. No, remember, this is only half year revenues. So if it was for the full year, it would be about double. But it doesn't matter because we're only really working on proportions. At least I don't think it does anyway. So let's do this. Remember to lock in. We're doing each one divided by the total to get its ratio, to get its proportion. 2 decimal place. Okay, we just want all of these to be 2 decimal places. Yeah, equals 1. So now the weighted beta is, how do we do this now? Yeah, multiply the unlevered beta by the proportion. Then we just do the sum, 1.14. So if it's not too far off what it's. But this is quite interesting, is that such a small amount of their revenue, but because the EV to sales is so high, it becomes a huge part of the company value. So the beta, what's that? That's, there we go. Now the last one, equity risk premium. And it does break down quite nicely. Do I have my... No, I don't. I need to get that in a second. Okay, so United States and Canada, Europe, Asia Pacific, rest of the world. We just use a North American one for this. Europe, there should be one already in place. APAC will have to do a bit of adjusting. Rest of the world includes Russia, Turkey. No, sorry. Europe includes Russia and Turkey. Rest of the world includes Africa, Latin America, and the Middle East. Okay. So we pull up this spreadsheet and we go to our, let's see what we can get from here first. So, okay, great. We have a North American one, 4.58%, and this is weighted by GDP. Okay, great. That's good. That's good. Asia. Okay, yeah, so we can have Europe, 5.43, that's good. Africa and Middle East, 9.38. Global, 5.88. Europe, Middle East, and Africa. 6.22. It wouldn't be, I mean, because obviously Facebook isn't in China, so we don't need that there. Small Asia, emerging markets. I think we can, no, because it doesn't include Japan. Okay, let's start building, and then we can. Okay, so we're gonna go US. Actually, we can just put North America. We want the revenues, the weight, the ERP, and then the weight ERP. So the revenues are easy because we have them here. For US and Canada, 35,323. 35,323. It's a lot of money. The weight is 100% here. And the ERP, what did we say it is for? North America, 4.58%. There we go. Then the next region we're going to do is Europe. And revenues are 27,409. Actually, no, we can't do the weight yet. We have to calculate that in a second. The ERP is... I'm just going to take a 1 Europe. We had it at the bottom, didn't we? I'm going to take a 1 Europe number, 5.43%. APAC. I mean, this is it's a genuinely global company. Look at the revenues are coming from everywhere. Remember when if you saw the Costco build that I did, it was I mean, it was overwhelmingly North America, and then the rest of the world was. I mean, the rest of the world had the same number of stores, I think, as Canada, or the same revenues as Canada. So yeah, whereas this one is fairly even across the whole thing. So where's that? What do I want to look at? Okay. So APAC, emerging markets, 7%. I think I will go with this 5.92 figure, I think. I know China's not in there, but without the breakdown, it is, I mean, it's not though, is it? Because it's weighted by GDP when you do it like this. But this, in China, Singapore. Yeah, okay, look, let's leave it as that. I think it's fine. Maybe, I mean, if we're going to, I mean, I'm sure there's a way to sort of find, maybe be a bit more pinpointing on ROW. Is 9661. And what do we think? Okay, what do we think this one is going to be? Because remember, it includes the Middle East, and it also includes Latin America. 9.38. Yeah, I think maybe, like, yeah, let's call it 9.45. Let's meet it in the middle. So, now we can do our weights. Remember, just lock in the last, the total, because we can pull this down. And now we have our 5.66. Okay. I mean, that's about right, I think. Now, to do the cost of equity, so the cost of equity equals, sorry, 1 second. Cost of equity equals the risk-free rate plus the beta multiplied by the equity risk premium. So if we do that here, we go risk-free rate plus the beta multiplied by the equity risk premium, we get a cost of equity of 10.61%. And I guess it's going to be high because Meta gets its revenues globally. I mean, apart from China, it gets its revenues from all over the world. So it's it's not going to have a solely US risk premium. Okay, now obviously we can ignore these because we've done them over there. We're going to do this now. So the WACC is equal to the percentage of equity multiplied by the cost of equity plus the percentage of debt multiplied by the cost of debt multiplied by 1 minus the tax rate. So let's do that. So we take our percentage of equity, multiply it by the cost of equity, and sometimes you can put these in brackets just to play safe, plus the percentage of debt multiplied by the cost of debt multiplied by, sorry, it needs to be 1 minus the tax rate. And this will give us our WACC. Oh, yeah, so 10 point. So about 10 point, yeah, about 10.53% for the WACC for Facebook. Yeah, okay, that's it. Let's come back and we'll do the DCF build later in the week, maybe over the next couple of days. I'll try and get it to you. But anyway, thank you, and we'll see you on the next one.